I am Mike D, and this is the history of money, banking, and trade. Here's what I want you to think about. Every financial system you interact with today, every bank, every currency, every credit agreement, is the product of thousands of years of human ingenuity, necessity, and occasionally spectacular failure. This podcast is the story of how it all began, evolved, and became the world we live in. We're starting in the ancient world, and we're not stopping until we reach the present. Welcome aboard. Before I continue with the broader ancient Roman series, I want to take a detour this episode, well, two detours actually, to talk about a pair of historical events that had a profound effect on the people of Rome and the story of money itself. The first story is the eruption of Mount Vesuvius. You probably heard of it. But the second story may genuinely surprise you. Rome experienced a full-blown financial crisis, a credit crunch, a property crash, a liquid freeze, and a government bailout. Nearly 2,000 years before the crisis that shook the global economy, starting in 2007. The parallels are not vague. They are, frankly, eerie. But before we get there, let me give you some background, or a refresher on how the Roman economy actually worked. Its plumbing, its mechanics, and its politics all played a central role in the crisis that would eventually hit the empire. First things first, you need to understand how commercial deals were done in Rome. Coins were principally used for small transactions, and in Rome's heyday, some big tickets were generally settled using promissory notes and bonds. The great orator and politician Cicero summarized the standard method of large payments in the late Republic this way: negotium conficit, meaning roughly one provides the bonds and completes the transaction. The poet Horace describes the typical wealthy Roman as rich in fields, rich in money, out at interest. In other words, if you were doing well in Rome, you were both a landowner and a lender. The two were inseparable. Bankers operated much as they do today. They took deposits, made loans, and facilitated international payments. And then, as now, this financial elite specialized in dazzling the uninitiated with the sophistication of their technique. The jaded Cicero wrote of them with pointed irony that, concerning the acquisition and placing of money and its use, certain excellent fellows, whose place of business is near the Temple of Janus, converse more eloquently than philosophers of any school. The Temple of Janus was Rome's version of Wall Street, and the bankers who worked in its shadow were its original masters of the universe. Julius Caesar, in his wisdom, had introduced a law specifying strict limits on how much of their total wealth the aristocracy could lend out. In modern terms, he introduced a capital adequacy requirement for lenders, a minimum floor of real assets that had to sit beneath all the credit activity. Does this sound familiar? Because it should. Regulators have been wrestling with this exact problem ever since. Before we dive into the crisis itself, let me introduce to you a thinker whose work sheds important light on why credit crises happen at all. Ferdinando Galiani was an 18th century Italian economist, a leading figure of the Enlightenment, who was born in Naples, not far from the ruins of Pompeii. Friedrich Nietzsche called him a most fastidious and refined intelligence, and, somewhat less flatteringly, the most profound, disconcerting, and perhaps also the filthiest man of his century. In 1751, Galiani published a book called On Monday, in which he wrote extensively about the nature of interest and usury. Galiani rejected the traditional view that charging for loans was inherently unjust. On the contrary, He correctly described interest as representing the difference between money available today and money available in the future. He justified the existence of interest on the grounds that every loan carries some risk of loss, which induces anxiety in the lender. He said, quote, keeping someone in anxiety is pain. He wrote, hence, it must be paid for. Interest, he concluded, is simply the price of anxiety. He argued that interest bears the same ratio to capital as the probability of loss bears to the probability of repayment. Since every loan carries a different risk, interest rates are as varied as almost the infinite degrees of possible loss. Very high in some cases, such as maritime loans on merchant ships, sometimes falling to near zero as in the banks of stable republics, and occasionally going negative, as what happened in France during John Law's notorious monetary system in the 18th century. From this perspective, Galiani said, interest can be understood as the price of insurance. The idea that interest and risk are interconnected had ancient roots, as we've seen. The Babylonians, the Greeks, and the Romans all charged higher premiums for loans on sea voyages than for loans secured by land because the sea was riskier. What Galiani gave was the formal language for something merchants had understood intuitively for millennia. Keep this framework in mind as we walk through what happened in Rome in 33 CE, because what unfolded was, in essence, a world where the price of anxiety suddenly shot up without warning, and the markets weren't ready for it. In 31 CE, the Emperor Tiberius, head of the Claudian dynasty, was enjoying something of a semi-retirement at his villa on the island of Capri. Tiberius was a consolidator rather than a conqueror. He preferred diplomacy to war. He kept the treasury well managed, and his reign had brought Rome a long stretch of peace and prosperity. In any era, peace breeds confidence, and confidence breeds credit. With money flowing into Rome and interest rates low, land prices climbed steadily. The property market was booming, and the Roman Senate, the class of wealthy aristocrats who theoretically governed the empire alongside the emperor, was doing very well indeed. But Tiberius's peaceful retirement was shattered by the news of an alleged coup. A young and ambitious officer named Sejanus had gathered a significant faction of senators and aristocrats behind him, and apparently with designs on the throne. Tiberius' spies moved quickly. Sejanus was arrested and executed. So were many of his supporters from the Senate. And then, in a move that would have consequences nobody anticipated, Tiberius confiscated the estates of the conspirators, stripping their assets for the benefit of the Roman state. Now, this is something that a lot of powerful kings and even presidents in modern eras probably would have done. What they didn't realize, or what they wouldn't realize, is the unintended consequences of this action. Therefore, this set off a chain reaction. And before we get there, let's pause here to understand what senators were actually doing with the money before the crisis hit. According to the historian Tacitus, by 33 CE, the vast majority of Roman senators had become moneylenders. Cut off by the law from direct commercial trade, lending was the primary mechanism by which the senators maintained and grew their fortunes. Roman historian Nathan Rosenstein's research on senatorial estates makes clear that, for most senators, farming alone simply wasn't profitable enough to sustain their lifestyle. So they had to find another way. And here's the setup. Senators could access capital cheaply in Rome, where interest rates were low, thanks to the peace and prosperity of Tiberius's reign. They would then lend that money out at significantly higher rates across Italy and into the provinces, which would have included, for example, Syria, Egypt, and Gaul. The margin between their borrowing costs and their lending rate was their profit. This is what the senators were doing. And if it sounds familiar, it should, especially if you're on Wall Street or in the investor space. Because what the senators were running essentially was an ancient version of the carry trade. So, for those who are unfamiliar with the term, a carry trade is an investment strategy where you borrow in a low interest environment and deploy that capital into a higher yielding asset or market. The goal is to profit from the interest rate differential, which is the carry, while assuming that conditions stay stable. In modern markets, the classic example is borrowing in Japanese yen, where the interest rates have been near zero for decades, and investing in US dollars or Mexican pesos, where yields are higher. The carry trade works beautifully until it doesn't. There is an old saying in finance that you may or may not be familiar with. It is picking up pennies in front of a steamroller. You can collect those pennies day after day, week after week, and the gains feel easy, almost automatic. But one sudden, violent reversal can wipe out years of accumulated profits in a matter of days. The strategy feels safe precisely because it works consistently, which encourages people to take on more and more leverage, and that leverage is the steamroller. The most dramatic example of a carry trade gone catastrophically wrong is long-term capital management, or LTCM, in the late 90s. LTCM was a hedge fund staffed by some of the most brilliant minds in all of finance, including 2 Nobel Prize winning economists. They borrowed heavily at its peak. The fund held about $125 billion in debt against just $4 billion in equity, a leverage ratio of roughly 30-1, to exploit tiny spreads between different types of bonds, betting that those spreads would narrow. The strategy worked perfectly until the 1997 Asian financial crisis and the 1998 Russian ruble default, which triggered a global flight to quality. Instead of the spreads narrowing, they widened dramatically. LTCM lost more than 40% of its capital and could no longer meet margin calls. The positions were too large to exit without causing the very collapse they feared. The federal government felt that they had no choice but to act because this could have caused a massive contagion and spread across the broader economy. Therefore, the Federal Reserve had to coordinate a $4 billion emergency rescue by the major investment banks to prevent a systemic meltdown. Now going back to ancient Rome. The senators of ancient Rome were running their own version of this trade. And like LTCM, they were leveraged to the hilt. When the steamroller came, it came fast. Now here's where the earlier Caesar legislation comes back into play. Julius Caesar responded to the financial crisis that had begun around 50 BCE and had peaked after his march onto Rome in 49 BCE, had passed a series of laws regulating credit. He required lenders to hold a certain proportion of their wealth in Italian land, the ancient equivalent of a capital adequacy requirement. He capped interest rates, allowed debt to be repaid in land at pre-crisis levels, canceled accrued interest on mortgages, and prohibited cash hoarding. These were emergency measures for a credit crisis, and many of them worked. But over the following decades, enforcement of these laws had quietly lapsed. Over 80 years, senators largely ignored them, and nobody pushed back. And in all honesty, this is kind of a recurring thing. I mean, we see this in modern economies. A crisis happens, laws are put in place to prevent the next crisis from happening, everything goes smoothly, and then everybody looks back at those laws and says, you know what, those things are terrible. Those aren't good for business. Those don't allow for more capital formation. So let's roll back these laws, or maybe let's just ignore them entirely. And then what happens? We get another credit crisis, or we get another kind of crisis. So this is kind of what was happening in ancient Rome. Things were going along smoothly. They kind of said, those laws from Caesar, those are old school. Those don't apply anymore, because that economy in 49 BCE was much different than the economy in 33 CE. So why are we partaking in these laws that limit the amount of money that can be generated in the economy? Then in 33 CE, for reasons historians still debate, some believe it was a deliberate political strategy on Tiberius' part, Roman courts began enforcing Caesar's old laws with full vigor. Upon examination, it became apparent that virtually all 600 senators were in violation. They had failed to hold the required proportion of their wealth in Italian land. In other words, there was laws that were passed and people just kind of ignored it. And then when you go to reinforce the old laws, everything is kind of out of proportion. Now everybody is no longer conforming to the previous laws. So what would happen, right? If we said that you couldn't hold XYZ stock, everybody starts holding XYZ stock to the point where it's a lot of people holding it and it has a high value, and people are forced to sell XYZ stock at the same time, well, you can imagine what's going to happen. Tiberius issued a decree. Lenders had 18 months to come into compliance. What followed was a textbook credit crunch. To raise cash and meet the new land ownership requirements, lenders began calling in their outstanding loans across Italy and the provinces. Suddenly, borrowers who had been perfectly comfortable found themselves facing immediate repayment demands. In desperation, they sold whatever they could, beginning with land. As distressed properties flooded the market, land prices fell sharply, as one would expect. And as land prices fell, the collateral underlying existing loans dropped in value too, which made lenders more nervous, which caused them to call in more loans, which forced even more sales, which pushed prices still lower. This is the classic doom loop. We've seen it in every major credit crisis in history. The situation was then compounded by a series of external shocks. 3 merchant ships owned by the Egyptian financial institution Sooth & Son sank. Their losses cascaded through the banking system, and a run began on those banks associated with them. Other banks, rather than helping stabilize the situation, refused to bail out the failing institutions. Does this sound familiar? Because this is the Lehman Brothers in 33. Banks in the great commercial cities of Tyre and Alexandria failed. Credit, which had been the lubricating fluid of the Roman economic machine, simply stopped flowing. Here is where the comparison to 2008 becomes almost uncomfortable in its precision. In the subprime mortgage crisis, the problem began with one segment of the U.S. housing market, loans made to borrowers with weak credit histories. But those mortgages had been bundled, sliced, repackaged, and sold throughout the global financial system. When the underlying loans went bad, the contagion spread everywhere, including to assets that had nothing obviously to do with American housing. The markets were so tightly interconnected that problems in one corner immediately contaminated everything else. Rome in 33 CE worked the same way. The senators' speculative loans had been made against collateral, typically a villa in Rome or the surrounding countryside. When provincial investments went bad, senators had to sell their prestigious Italian properties to cover the losses. The collapse in the provincial land values triggered falls in the Italian land values. Everything was tied together. As Tacitus put it, the destruction of private wealth precipitated the fall of rank and reputation. A great analogy could be it's like climbers roped together on a mountain face. If one fell, the weight would drag the next one over the cliff. Then, hoarding made it worse. When things turn sour and people lose faith in the system, the instinct is to grab whatever is universally recognized as safe, such as hard money, gold, and silver. In Rome, wealthy citizens began hoarding precious metals rather than deploying them into the economy. The money supply contracted sharply, just as it was needed the most. This dynamic played out nearly identically during the Great Depression when Americans hoarded gold following the 1929 crash. The more people stockpiled gold, the more its perceived value rose, and the more liquidity drained from the system. The fear became self-fulfilling. Senator Nerva, a prominent figure and close associate of Tiberius, reportedly starved himself to death. Whether this was a principled protest against what he believed was a catastrophic imperial policy, or whether he had simply been financially ruined and saw no other way out, the historical record doesn't tell us for certain. Probably some combination of both. Tacitus described the consequences in plain and devastating terms when he said, quote, "Hence followed a scarcity of money, a great shock being given to all credits. Therefore, many were utterly ruined," unquote. Tiberius had set the crisis in motion deliberately, using the credit system as a weapon against a Senate he no longer trusted. But in doing so, he discovers something that every ruler and every central banker since has had to learn the hard way. The forces unleashed by credit and the credit cycle are bigger than any individual politician or policy. He had gone too far. The financial contagion was threatening to consume the entire Roman economy, not just the senators he wanted to punish. I heard Dan Carlin give a great quote on the unintended consequences of the German policy to take the Russians out of the war in 1917 when they sent Lenin back to Russia to hopefully cause a revolution that could knock the Russians out of the war. What I remember Dan Carlin saying was, it's almost like you have beef with a neighbor in your apartment complex. So you light the apartment on fire, hoping to get them out of the complex, but that fire comes to your apartment building. So Tiberius changed course. His solution was elegant in its simplicity. According to Tacitus, the emperor injected 100 million sesterces into the credit markets through the Roman banking system, which distributed the funds across multiple banks, who then made 3-year interest-free mortgage loans to distressed borrowers. In return, the emperor required collateral worth double the value of any loan extended. The state became the lender of last resort. Now, to put that number into context, the bailout represented roughly 4% of total government funds and was approximately 100 times the wealth qualification required to hold a seat in the Senate during the early Republican period. It was not a trivial intervention. The markets recalibrated. Confidence gradually returned. The doom loop was broken. Note crucially how this was executed. Tiberius did not open the treasury and carry bags of sesterces across the forum. The operation was almost certainly conducted through accounting transfers. A government committed to provide capital against which the banks could write mortgages. A government guaranteed to back the banks was, in practical terms, as good as hard money. The machinery of financial rescue in ancient Rome would be instantly recognizable to any modern central banker. In doing this, Tiberius wrote the playbook that Ben Bernanke would follow 2,000 years later. When the 2008 financial crisis hit, The Federal Reserve flooded the banking system with liquidity through a series of emergency lending programs and quantitative easing, which is buying assets, backstopping institutions, and ensuring solvent banks had access to cash even when the markets had frozen. The underlying logic was identical. When private credit collapses, the sovereign steps in as a lender of last resort to prevent a liquidity crisis from becoming a solvency catastrophe. However, there is one key difference worth noting. Tiberius was tougher than Bernanke. While the Fed in 2008 largely extended capital with few strings attached, the infamous TARP program came in with minimal conditions and in some cases outright forgiveness. Tiberius demanded collateral worth twice the value of every loan he extended. His intervention was a masterstroke of power as well as policy. The senators couldn't refuse. Refusing meant bankruptcy and public shame. Accepting meant surrendering land to the emperor at a deeply discounted price. Tiberius got what he wanted either way. Rarely in history has liquidity been more expensive. The crisis of 33 CE also shows us the close and enduring connections between politics and finance. The crisis was not purely economic in origin. It followed a political purge and was, in at least part, a financial purge as well. And yet, it escaped the emperor's control and threatened to bring down the entire economic system. By attempting to assert dominance over the senatorial class through the credit system, Tiberius inadvertently demonstrated just how powerful and dangerous that system was. When Tiberius died 4 years later, he left behind a treasury of 2.7 billion sesterces, a vast surplus built up through his careful, conservative management. His legacy was complicated. He was feared, mistrusted, and often cruel. But as a financial steward, he understood something fundamental. The state must ultimately be the guarantor of the financial system, or the financial system will collapse. Now let's turn to the second story of the episode, one that needs no financial crisis to be devastating, though it had profound economic consequences of its own. In the spring of 1959, construction on a highway from Naples to Salerno came to a halt. Workers digging the route, which passed roughly half a mile south of Pompeii near the intersection of an old Roman road, began uncovering the traces of an ancient ruin. Excavation through layers of volcanic ash eventually revealed a beautifully preserved courtyard surrounded by decorated meeting rooms. Inside one of those rooms, archaeologists found a basket filled with folding wooden tablets, a legal archive belonging to a banking family called the Sulpicii, almost certainly abandoned in the chaos of Mount Vesuvius' eruption in 79 CE. The tablets contain years' worth of loans, lawsuits, and commercial transactions. They revealed that the Sulpicii were a sophisticated banking family, bankers in the truest sense. They took deposits, made account transfers, extended loans, brokered investments, and made advances to successful bidders at auctions. Most of the records date from right around the financial crisis of 33 CE and the decades or two that followed it. The tablets tell the story of deals struck in and around Puteoli, a bustling ancient port city on the Bay of Naples. Much of the business involved the great Alexandrian grain trade, the merchant fleets that carried Egyptian wheat, wine, and luxury goods north across the Mediterranean to feed the Roman population. This was the commercial world of ancient Pompeii, and in the summer of 79 CE, it was the most fashionable place in the empire. Mount Vesuvius and the Bay of Naples were, in the 1st century CE, the Roman equivalent of the Hamptons, a premier summer resort for the wealthy elite. The Campania region, with its stunning coastline, thermal baths, and great volcanic soil that produced some of the finest wines in the empire had long attracted the richest and most powerful Romans. Cities like Herculaneum and Pompeii were packed with luxurious seaside villas, extravagant gardens, elaborate public baths, and fine dining establishments. Emperors, senators, generals, and celebrities all made their way south for the summer. It was, in short, the place to be seen. The Bay of Naples, what we now call the Amalfi Coast, and the waters surrounding Sorrento was the playground of Rome's elite. Herculaneum was particularly fashionable among the very wealthy, while Pompeii was the livelier, more commercial resort city. Think of Herculaneum as the quieter, more exclusive enclave, and Pompeii as the busier, more social scene, with taverns, street food stalls, theaters, baths, gladiatorial games, and the kind of gossip that accumulates when powerful people are off their guard and close together. The Italian holiday season we still observe today, Ferragosto, takes its name from the festival of Augustus. The Emperor Augustus essentially institutionalized the Roman summer vacation, and the tradition persists to this day. In 79 CE, August was the height of the social season. The finest villas around the bay were packed. Among the upper crust that summer was Pliny the Younger, the premier essayist and correspondent of his day, and one of the most important eyewitnesses in ancient history. Through his letters, many of our most vivid impressions of Roman life have been preserved. He was staying near the Bay of Naples with his uncle, Pliny the Elder, the famous naturalist and naval commander, when events took an irreversible turn. On the morning of August 24th, 79 CE, Vesuvius exploded. At roughly noon, the summit of the volcano blew open, propelling a mushroom cloud of ash and pumice some 10 miles into the sky, releasing, according to modern estimates, 100,000 times the thermal energy of the atomic bomb dropped on Hiroshima. The eruption would last approximately 18 hours. Volcanic ash and pumice stones rained down on Pompeii for hours, forcing residents into the streets and then back inside as debris accumulated on rooftops and began to collapse them. Herculaneum, which was slightly closer to the volcano, was largely sheltered from the initial ashfall by the direction of the wind, and it appeared at first to be more fortunate. But it was not. As Pliny the Younger later described in his letters to the historian Tacitus, letters which remain among the most extraordinary eyewitness accounts in all of antiquity, the sky turned black with acid and sulfurous smoke. The sun disappeared. A blanket of darkness fell over the bay in the middle of the afternoon. His uncle Pliny the Elder, who commanded the Roman fleet at nearby Misenum, launched rescue ships towards the stricken coast. He never returned. He died, overcome by toxic fumes, still trying to help the survivors. In the early hours of August 25th, the towering column of volcanic material collapsed under its own weight, sending pyroclastic surges, which were waves of superheated gas, ash, and rock fragments traveling at hurricane speeds, heated to approximately 700 degrees Celsius, cascading down the flanks of the mountain towards the coast. Everyone who had taken shelter on the beach of Heracleum and in the city's boathouses died instantly. Modern studies of the skeletal remains suggest that many of the victims' bodily fluids vaporized on impact. Death was not slow, it was total, absolute, and nearly instantaneous. Pompeii died a slightly different death. The city was buried under 14 to 17 feet of ash and pumice. The final pyroclastic surges killed anyone still alive in the city, but many had already succumbed to collapsing roofs and toxic gases during the night. The preserved remains of approximately 1,500 people have been found at 2 sites combined. The total death toll across the region is estimated to be about 16,000 or possibly even more. Days later, when the smoke cleared and the ash settled, an extraordinary silence fell over the bay. Where 2 prosperous trading cities had hummed with commercial life, there was now a still gray landscape under a blanket of ash, warm, soft, almost peaceful, concealing the catastrophe beneath it. Both cities were effectively forgotten within a generation. Over centuries, the ash compacted into soil. The volcanic material, rich in minerals, turned the fields around Vesuvius into some of the most fertile in all of Italy. Green pastures and vineyards obscured what lay below. Then, in 1860, a team of archaeologists led by Giuseppe Fiorelli began systematic excavations at Pompeii. What they found was staggering. An entire city frozen in time. Ornate villas, gladiatorial arenas, markets, bakeries, brothels, theaters, gymnasiums, and even bowls with traces of soup still visible. Fiorelli's great innovation was the technique of filling the voids left in the ash by decomposed bodies with liquid plaster, creating haunting, precise casts of the victims in their final moments. They are among the most affecting objects in all of archaeology. What emerged from the ash was not just a physical city, but a complete economic ecosystem. Mosaics in the entrance halls of Pompeii homes read Salve Lucrum, which meant hail profits, and there was others that said Lucrum Gaudium, which means profit is delight. Commerce was not a dirty word in Pompeii. It was a civic virtue, practically a religion. And the object of that religion was Mercury. The god of commerce appeared on 19 of the 29 painted commercial facades that had been excavated, which depicted a winged figure carrying a bag of coins. An elaborate shrine to Mercury adorned the central food market. The Pompeians prayed to Mercury not for lightning or heroic strength, but because he was the god of negotiation, trade, and deal-making. The word commerce itself comes from the Roman phrase com merx, with Mercury. And the metal mercury, which is quicksilver, was the only metal that remains liquid at room temperature, always moving, never fixed, shape-shifting, and elusive, much like money itself. Don't let the word ancient fool you into imagining a small parochial market town. Pompeii was a node in a sophisticated global trading network. Archaeological evidence recovered from the site tells an international story. A golden necklace set with rough-cut emeralds, a stone only available in Egyptian mines, was found on one of the skeletal remains. 2 skeletons of African origin were recovered. An ivory statue of Indian origin was found in the ruins. Pliny the Elder had complained bitterly for decades earlier about Rome running a massive trade deficit with India because wealthy Romans were importing silks, spices, and jewels, paying for them in gold that never returned. Large quantities of coins from the Western Mediterranean ports of modern Ibiza and Marseille were found at the site, thus demonstrating that Pompeii's merchants were active across the entire breadth of the Roman world. Pompeii was a miniature version of Rome itself. The city could not feed itself like Athens before it. It relied on commerce to persuade others to grow its food. Its economy was built on trade, on a strategic position on the Bay of Naples, and on specialty sauces such as garum, which was this interesting fish sauce that kind of serves the same function as soy sauce or Worcestershire sauce in modern cooking. Another famous local product would have been the wine from its famously fertile volcanic soil of Campania, as well as the textiles that it produced. These industries were destroyed overnight by the eruption. Workshops went cold, merchants who had survived fled and never returned, supply chains that had taken generations to build suddenly evaporated. The nearly 33,000 coins recovered from Pompeii, which were far more than the few thousand coins that were found at Herculaneum, tell a poignant human story. Most were everyday losses, coins dropped in the streets and buried in construction fill, but some were hoards carried by people who waited too long to flee. In the House of the Golden Bracelets, archaeologists found a family of 4, a couple and their 2 young children, sheltering in the ground floor alcove. The mother wore a golden bracelet for which the house is named. Around her were 40 gold coins and about 172 silver denarii, which was a substantial sum. They had waited too long. The plaster casts of their bodies preserved the anguish of their final moments with unbearable clarity. Along the beachfront of Herculaneum, hundreds of residents had gathered in boathouses and on the shore, apparently waiting for rescue ships. Remarkably, given the chaos of the night, there were no piles of trampled bodies at the narrow passageways leading down to the shore, suggesting that even in their terror, these people had helped one another through the dark. Then the final pyroclastic surge arrived and killed them all. Among the dead, around 300 persons, 2 horses, several dogs, and as the records indicate, at least a few people yet not born. Lying face down on the beach, a large, well-built man was found carrying carpentry tools and a hoard of 15 silver denarii and 3 gold aurei. Was he a soldier maintaining order on the waterfront? Was he a builder protecting his life savings? A looter taking advantage of the chaos? His coins cannot tell us who he was, only that he had died relatively wealthy, and that the money, in the end, was worth nothing. In Boathouse 11, archaeologists found a hoard of bronze and silver coins fused together, still in the shape of the wicker basket that had held them when the pyroclastic surge hit. Someone had been trying to carry their savings to safety in a basket. They didn't make it. This is the power of Pompeii as a historical record. It doesn't just show us temples and mosaics. It shows us ordinary people on an extraordinary night, making the same decisions we would make, protecting their money, hesitating too long, hoping that tomorrow would come. For them, it didn't. The eruption of Vesuvius does not have a direct financial parallel in the sense of a market collapse or a credit crisis, but it shares something important with the greatest natural disasters in modern history: the sudden, total destruction of a thriving economic ecosystem and the questions of what comes after. The closest modern parallel that I could come up with is Hurricane Katrina in 2005. Before the storm, the New Orleans region supported approximately 1 million non-farm jobs. The hurricane destroyed more than 200,000 homes, more than the San Francisco earthquake and the fire of 1906 combined. The total economic impact to Louisiana and Mississippi alone was estimated at over $150 billion. The port of New Orleans, which handled roughly 16% of the nation's crude oil and natural gas supply, was crippled for weeks. As with Pompeii and Herculaneum, entire communities were not just damaged but effectively eliminated. Unlike Pompeii, New Orleans eventually rebuilt. But 15 years after the storm, large sections of the city had not recovered their pre-hurricane populations. Now, the San Francisco earthquake of 1906 offers an instructive comparison, one that, like the Roman financial crisis, had ripple effects far beyond the immediate disaster zone. On April 18, 1906, a magnitude 7.9 earthquake struck the city, followed by a fire that burned for 3 days and destroyed some 28,000 buildings across more than 4 square miles of the city center. Over 3,000 people died, and an estimated 225,000 of the city's 400,000 residents were left homeless. Property damage was estimated at nearly $400 million in 1906 dollars, equivalent to roughly $32 billion today. But here is what makes the San Francisco earthquake particularly relevant to the podcast about money and finance. The aftermath triggered a global financial crisis. Foreign insurance companies, primarily British and European, were obligated to pay out enormous claims on their San Francisco policies. To do so, they had to repatriate gold from the United States back to Europe. This large outflow of gold prompted the Bank of England to raise interest rates and discriminate against American financial bills. Other European banks followed. The resulting credit tightening pushed the United States into a recession and set the stage for the Panic of 1907, a full-scale banking crisis in which dozens of American banks and trust companies failed. It required the intervention of J.P. Morgan himself, acting as an informal lender of last resort before the Federal Reserve even existed to stabilize the system. A local disaster, a global financial ripple. Sound familiar? In 79 CE, the destruction of Pompeii and Herculaneum disrupted the Alexandrian grain trade, the garum supply chains, which was the fish oil that I talked about earlier, and the commercial networks that the Sepulcri banking family and others like them had built over generations. The economic shock was local in geography but systemic in its implications for the tightly interconnected Roman economy. The archive discovered in the ruins in 1959 gives us a remarkable window into the day-to-day mechanics of Roman commercial banking in the decades following the crisis of 33 CE. The Sepulcri family records show a banking operation of genuine sophistication. Financial writer and classical scholar David Jones has reconstructed the firm's dealings from an in-depth study of the hundreds of tablets recovered. Their business was deeply embedded in the Alexandrian grain trade. On June 18, 37 CE, just 4 years after the financial crisis, a freedman who was a former slave borrowed 10,000 sesterces from another freedman, executing the agreement through his own slave. One of the parties pledged 7,000 mode of grain, which was roughly to 2,100 cubic feet plus 200 sacks of chickpeas, lentils, and legumes stored in a public warehouse, with the borrower accepting full risk of losses through spoilage, theft, or non-repayment of warehouse rent. This is commodity-backed lending 2,000 years before the Chicago Board of Trade. These were real financial contracts enforceable in Roman courts involving detailed calculations of risk, collateral, and counterparty obligations. It is, in miniature, the same architecture that underlies modern secured lending. The archive also reflects an important point on how Roman finance actually worked at the operational level. Most transactions of this kind were conducted not by members of the aristocratic class, but by freedmen and slaves, the commercial middle class of the Roman world. The senators and quaestorians provided the capital. The freedmen and slaves did the work. The separation of ownership and management is itself a recognizable feature of any modern financial system. Both stories we explore today, the financial crisis of 33 CE and the eruption of Vesuvius in 79 CE, point to the same underlying truth about money, credit, and economic life. Systems that appear robust can be extraordinarily fragile. A single shock, a law enforced after decades of neglect, a volcano that had become dormant within living memory, can unravel in days what took generations to build. The interconnectedness that makes a credit economy powerful also makes it vulnerable. The senator who borrows cheaply in Rome and lends extensively in Syria was connected to the merchant in Alexandria, who was connected to the grain shipper in Egypt, who was connected to the baker in Pompeii. Pull one thread, and the whole fabric tightens. And the response to these crises, government intervention, liquidity injections, the assertion of state power as the ultimate backstop of the financial system, are not modern inventions. They are as old as money itself. When Tiberius injected 100 million sesterces into the Roman banking system in 33 CE, he was doing something that Ben Bernanke, Hank Paulson, and Timothy Geithner would do 2,000 years later. When Emperor Titus sent magistrates to Campania after the eruption of Vesuvius and directed that those estates of those who had died without heirs to be used for regional reconstruction, he was executing something that looks, in routine, remarkably like disaster relief policies. The details changed, the human imperatives did not. The credit cycle gives and it takes away. The shift from coins to credit enabled Rome to build its empire, to project power, fund armies, and sustain a population of over 1 million people in a single city. But credit made the system financially fragile. Booms and busts become more frequent, more violent, and more psychologically consuming. The pendulum of greed and fear swung harder and faster once credit amplified every movement. And when things finally went too far, when the political purge became a financial crisis, when the volcano buried the summer playground of the wealthy along with its merchants and bankers and slaves and children, the world moved on, as it always does. The ash compacted into a fertile soil. New vines grew. New bankers set up shop. And new credit was extended. That's the story of money. It doesn't end. It evolves. That's a wrap on this episode. We covered a lot of ground today. An ancient credit crisis with eerie parallels to the 2008 financial crisis. A volcano that buried one of the ancient world's most dynamic commercial cities. And the timeless human drama of money. Who has it? Who wants it? And what happens when it disappears? If this is the kind of history you want more of, the best thing you can do is leave a 5-star review and pass it along to someone who would appreciate it. Word of mouth is everything for an independent show like this one. If you want to support the podcast directly and keep it going, you can find us on Patreon at patreon.com/historyofmoneybankingtrade or visit our website at moneybankingtrade.com. Until next time, I am Mike D, and this has been the history of money, banking, and trade.